FactWire Report. Google ships Gemini 3, AI wired into search. Trump warns against overregulation, pushing one federal standard. The S&P 500 falls a fourth day as valuations bite. Home Depot slips. Jobless rolls swelled. No fluff, just facts. Stay. One clean chart at the end shows the real driver. Google is making its biggest bet yet on AI inside its most valuable product, search. The company has launched Gemini 3, its latest flagship model, and for the first time it is wired into Google Search from day one instead of arriving weeks or months later. Executives say the upgrade is already powering multiple revenue-generating products, from classic search results to premium AI features. Alphabet and Google CEO Sundar Pichai describes Gemini 3 as the company's most intelligent model so far, pointing to strong performance on widely watched AI benchmarks. But even he acknowledges that the real test is no longer leaderboard scores. Investors now want to know whether new models can solve practical problems, keep people inside Google's ecosystem, and justify the billions of dollars being poured into AI infrastructure. One of the headline features is Gemini Agent, an AI assistant designed to handle multi-step tasks. Google showed how it can sort a cluttered inbox, extract key dates and documents, and even book travel inside a single flow. Instead of simply answering one question at a time, the agent is meant to behave more like a digital chief of staff, planning and executing several actions on the user's behalf. For developers, Google previewed Anti-Gravity, a platform where AI agents can plan and run coding tasks with minimal human intervention. Gemini 3 is also reshaping how search results look. In Google's dedicated Gemini app and in AI-forward search modes, answers now appear more like full web pages, with structured sections, visuals, and interactive elements generated on the fly. In one demo, Google built a virtual Van Gogh gallery, complete with biographical context, artwork descriptions, and navigation controls, all inside the response itself. That kind of experience could be convenient for users, but it raises concerns for traditional publishers who rely on click-through traffic to fund their newsrooms and websites. For paying customers on Google's premium AI subscription, Gemini 3 is being positioned as a step toward a universal assistant that works across Search, Gmail, Docs, and Android. At the same time, Google faces pressure from regulators and competitors as AI-powered search blurs the line between answering questions and aggregating other people's content. With Wall Street increasingly alert to the risk of an AI investment bubble, the success of Gemini 3 will be judged less by how smart it looks in a demo and more by whether it delivers sustainable revenue without breaking trust with users, partners, and regulators. Before we turn to markets and jobs, let's look at how politics is shaping the AI race. In Washington, U.S. President Donald Trump is pushing for a single federal rulebook for artificial intelligence and warning against a patchwork of state regulations. U.S. President Donald Trump is putting artificial intelligence at the center of his economic and national strategy, and now he is drawing a red line on how it should be regulated. In a new social media post, Trump warned that the United States risks over-regulation if each of the 50 states writes its own rules for AI. He argued that this patchwork approach could slow investment, confuse companies, and give China an easier path to catching up in the global AI race. Trump is calling for a single federal standard that would set the ground rules for how AI is developed and deployed across the country. He did not spell out the details of that standard, but he urged congressmen to attach it to the massive annual defense policy bill, known as the National Defense Authorization Act, or NDAA, or to pass it as a separate law. The message fits with his broader push to position the United States as what he has called the world capital of artificial intelligence. Soon after starting his second term in January, Trump ordered his administration to produce an AI action plan aimed at accelerating research, expanding infrastructure, and reducing regulatory barriers that companies say can slow deployment. Supporters argue that a clear national framework could help businesses invest with more confidence and avoid navigating dozens of different rulebooks. They also claim that if the U.S. falls behind in AI, it could lose both economic strength and strategic leverage in competition with China. At the same time, the rise of AI has triggered a long list of concerns in Washington and beyond. Policymakers, researchers, and civil society groups warn that powerful systems can be misused to spread disinformation, disrupt elections, enable large-scale fraud, or displace workers in sensitive industries. Some lawmakers have pushed for stronger guardrails, especially around deepfakes, data privacy, and high-risk uses in areas like critical infrastructure and public services. Trump's latest comments sharpen the contrast between those who want aggressive new limits on AI and those who prioritize flexibility and rapid deployment. A single federal standard could eventually preempt stricter state rules, which some technology companies would welcome and some local officials would resist. For now, the proposal exists mainly as a political signal. The administration wants Congress to move quickly, but key questions remain unanswered, including how to balance innovation with safety, who will enforce the rules, and how much power states will retain in one of the most consequential technologies of this decade. Next, we move from regulation to results. Wall Street has been repricing expectations for growth, interest rates, and the AI trade, sending the S&P 500 to a fourth straight loss and putting extra focus on big retailers and home improvement demand. Wall Street just logged another down day, and this time the focus is squarely on valuations and expectations rather than a single shock headline. On Tuesday, the S&P 500 fell for a fourth straight session, its longest losing streak in 3 months, as investors question whether big technology-related stocks have run too far, too fast. The benchmark index slipped about 0.8%, while the Dow lost just over 1% and the Nasdaq dropped more than 1.2%, extending a pullback of roughly 4% from the S&P 500's October peak. The pressure was most visible in mega-cap names that powered this year's rally. NVIDIA, widely seen as a bellwether for enthusiasm around artificial intelligence, fell nearly 3% ahead of its upcoming earnings report. Amazon slid more than 4%. Together, those moves added to a sense that investors are reassessing how much future AI growth is already priced into today's share prices, especially after a long run where strong demand for chips and cloud services helped lift the entire market. Home Depot added a more traditional warning signal. Shares of the home improvement retailer dropped about 6% after the company delivered quarterly earnings that missed expectations and issued a full-year profit forecast that disappointed analysts. That reaction shows how sensitive the market has become to any sign that household spending or housing-related demand might be under strain, particularly at a time when borrowing costs remain relatively high and consumers are becoming more selective. Under the surface, the picture was more nuanced than the headline losses suggest. 6 of the 11 main S&P 500 sectors actually ended the day higher, and the small-cap Russell 2000 index managed a modest gain. Some traders argue that what we are seeing is less a broad breakdown and more a rotation, investors trimming richly valued giants and redistributing money toward areas that have lagged behind. A widely watched chart of the S&P 500 price-to-earnings ratio underscores why valuations are under scrutiny, with the index still trading at levels that look stretched to some long-term investors. Earnings season itself has been stronger than many feared. Year-over-year profit growth for companies in the S&P 500 is running close to 17%, nearly double the pace analysts projected at the start of October. Even so, doubts about a near-term interest rate cut and signs of cooling in the labor market are making traders more cautious. A delayed U.S. jobs report is due later this week, and fresh data already show that the number of Americans on jobless benefits jumped between mid-September and mid-October. Taken together, that mix of solid corporate results, elevated valuations, and softer employment data is forcing markets to reconsider how much good news is already reflected in prices and how much room is left if growth and rates move in a less friendly direction. The market story doesn't end on the trading floor.
Behind the latest moves is a softer labor backdrop, with new data showing that U.S. unemployment rolls swelled between mid-September and mid-October, raising fresh questions about household finances and future demand. The latest snapshot of the U.S. labor market shows a job picture that is softer, not collapsing, but still uncomfortable for many households. Government data now confirm that the number of Americans receiving unemployment benefits jumped between mid-September and mid-October, reaching the highest level in about 2 months. The update arrived only after the end of a prolonged government shutdown that delayed the release of key economic figures and left markets and workers flying partly blind. The increase centers on so-called continuing claims, which track people who remain on benefits after an initial week of aid and are often used as a rough gauge of how easy it is to find a new job. Those claims climbed to about 1.96 million in the week ending October 18th, up by 10,000 from the previous week and sharply higher than the roughly 1.92 million level recorded in mid-September before the shutdown began. That pattern points to slower hiring and suggests the unemployment rate for October could have moved higher once the delayed data are finally published. At the same time, new applications for jobless benefits remained relatively stable during the survey period at about 232,000 a week, still within the range seen before the shutdown. That combination of rising continuing claims but steady initial claims has led some economists to argue that the labor market is cooling rather than breaking. One analyst noted that there is no clear evidence of a sudden wave of layoffs tied directly to the shutdown itself, and that should be mildly reassuring for markets trying to assess the next move in interest rates. Earlier this year, the unemployment rate rose to roughly 4.3%, close to a 4-year high, reinforcing the idea that the period of exceptionally tight labor conditions is behind the economy. Job openings have fallen, and there are now more unemployed workers than vacancies, a reversal from the immediate post-pandemic era. The Labor Department is preparing to release the long-delayed September employment report, but the October unemployment rate may not be available at all because survey work could not be completed during the shutdown. That gap will make it harder for policymakers to get a clean read on the trend. The strain is already visible in housing. Separate data show that U.S. homebuilder sentiment remains subdued in November, stuck below the break-even level for the 19th straight month. The National Association of Home Builders Index edged up to 38, but concerns about job security, wages, and still elevated mortgage rates continue to weigh on demand. More builders are cutting prices, 41%, the highest share since mid-2020, and roughly 2/3 are using incentives to close deals. Economists say a more meaningful turnaround in the housing market may have to wait until mortgage rates fall further and the labor market gradually improves, a process they do not expect to fully play out until at least 2026. For households, the message is mixed. Jobs are still available, but transitions are taking longer. For builders and lenders, a softer labor backdrop means more caution, more incentives, and a slower, uneven recovery. That was FactWire Report. If this saved you time, subscribe, tap the bell, and like. Comment Gemini 3, regulation, valuations, or jobs, which mattered most. Share with one friend who watches markets. We post concise, verified news daily. See you tomorrow. Stay to the end. Our closing chart turns headlines into signal so you decide faster, calmer, smarter every single day.